Imagine checking your account and seeing thousands of dollars. You believe the money is yours. You trust that you can withdraw it whenever you want. Now imagine discovering that the money isn't actually sitting there. That's what happens to customers of FTX. The company had once been valued at $32 billion. Its founder, Sam Bankman-Fried, had become a billionaire. But behind the enormous valuation, billions of dollars were moving through a system customers didn't fully understand. And when everyone wanted their money back, the system collapsed. But where had the money gone? Sam Bankman-Fried didn't look like the stereotypical billionaire. He wore shorts and t-shirts, he drove an ordinary-looking car, and he often presented himself as someone more interested in building a better financial system than becoming rich. But behind the casual appearance was an ambitious young trader. He became fascinated by cryptocurrency and began trading digital assets. Then he saw something others had missed. Different cryptocurrency markets sometimes had significant price differences. If he could buy an asset cheaply in one market and sell it for more somewhere else, there was money to be made. That opportunity eventually led to the creation of Alameda Research. And then came FTX. But SBF wasn't finished. He wasn't just trying to make money from crypto. He wanted to build an empire around it. Alameda had started making money from cryptocurrency trading. Then FTX started growing. The exchange attracted customers who bought and sold cryptocurrency through its platform. Investors poured money into the company. FTX expanded internationally, and its valuation climbed. Eventually, investors valued FTX at around $32 billion. SBF's personal wealth soared with it. He had gone from a relatively unknown crypto trader to a billionaire before the age of 30. But there was something important about that fortune. A valuation isn't the same thing as cash in the bank. SBF was considered a billionaire largely because of the value investors placed on his companies and his ownership stakes. And the higher FTX's valuation climbed, the more powerful the empire appeared. But underneath FTX was another company, Alameda Research, and the relationship between the two would become crucial. Alameda Research was SBF's trading company. FTX was his cryptocurrency exchange. On the surface, they were separate businesses, but they were closely connected. SBF controlled both. Alameda had started making money from cryptocurrency trading. FTX started growing into a major exchange, and as the two companies became more powerful, money and assets moved between them. That relationship would eventually become one of the biggest problems in the entire FTX story. Because an exchange is supposed to hold customer funds safely. It shouldn't be secretly using those funds to finance a separate trading operation. But that is where the story became dangerous. Because behind the success of FTX, Alameda was taking risks. Let's make this simple. You deposit $10,000 into FTX. You believe you have $10,000. But imagine that behind the scenes, Alameda takes that money and uses it to make a trade. If the trade succeeds, maybe the money comes back. But if the trade fails, your $10,000 is gone. Now multiply that by thousands of customers, then millions, then billions. Suddenly, FTX wasn't simply an exchange. It had become a source of funding for Alameda. And the more Alameda needed, the greater the hole could become. But how long could they keep that hole hidden? For a while, the rising crypto market made almost everything look better. Bitcoin was booming. Crypto companies were raising huge amounts of money. FTX was expanding. SBF was becoming a billionaire. Then the market turned. Crypto prices began falling sharply in 2022. Companies that had looked unstoppable started collapsing, and Alameda was exposed to many of those falling assets. The losses were growing, but FTX was still standing. SBF continued presenting himself as the man who could save the industry. What nobody outside the inner circle knew was how much pressure was building underneath the empire. On paper, Alameda had billions of dollars in assets. But when the balance sheet became public, people started looking closer. The document showed about $14.6 billion in assets as of June 30th, 2022. And a huge part of that was FTT, a token issued by FTX. That was strange, because FTX and Alameda were supposed to be separate businesses. Yet, Alameda's financial strength appeared heavily connected to an asset created by the other company. And suddenly, people weren't just asking how much Alameda was worth. They were asking, what happens if the value of FTT falls? Imagine a bank. Thousands of people believe their money is safe. Then one morning, rumors spread that the bank may not have enough cash. So everyone runs to withdraw their money. The first people get theirs, then more people arrive. And eventually, there isn't enough left. That is essentially what happened to FTX. After confidence in the company, it began collapsing. Customers rushed to withdraw their funds. FTX faced billions of dollars in withdrawal requests, but much of the money customers believed was available wasn't sitting there waiting for them. The company was suddenly facing the nightmare every financial institution fears, a run. And this one was happening in public. November 11th, 2022. The day Sam Bankman-Fried stepped down as CEO of FTX, the day the company filed for bankruptcy. Just days earlier, SBF had been one of the most recognizable people in crypto. Now his company was under the control of a new team brought in to manage the bankruptcy. The new CEO, John Ray III, would later describe the situation as extraordinarily disorganized and difficult to manage. FTX wasn't simply short of money. Its internal systems and corporate controls were also in serious trouble. The image of the sophisticated crypto empire was disappearing. What remained was a massive financial mess, and investigators were about to start digging through it. FTX had looked like a financial revolution, but when it collapsed, the victims weren't just anonymous numbers on a spreadsheet. They were customers who couldn't access their money, employees who lost their jobs, investors who watched billions in value disappear, companies that depended on FTX, and an entire industry whose reputation had been damaged. The empire had been built on trust, and when that trust disappeared, the damage spread far beyond the company itself. But the biggest consequence was still waiting, because Sam Bankman-Fried wasn't finished with FTX. He was about to face it in court. The verdict came first. Guilty on all 7 counts. But getting there meant hearing from people who had been inside SBF's empire. Caroline Ellison, the former CEO of Alameda Research who also happened to be SBF's former girlfriend. Gary Wang, an FTX co-founder and former chief technology officer. And Nishad Singh, a former FTX engineering executive. They testified for the prosecution about what they said happened inside FTX and Alameda, including the use of FTX customer funds. The defense argued that the collapse wasn't the result of intentional fraud. But the jury reached its verdict. Sam Bankman-Fried was found guilty on 7 federal counts. Then came the sentence. In March 2024, he was sentenced to 25 years in federal prison in order to forfeit more than $11 billion. The billionaire was gone. The company was gone. The empire was gone. And now there was only one question left. How could so many people have believed in it? Everyone around FTX had a story they wanted to believe. Investors wanted to believe they had found the next great financial company. Customers wanted to believe their money was safe. The crypto industry wanted a leader who could make it respectable, and SBF wanted to become that leader. The story became so powerful that the people believing it didn't always stop to examine what was underneath, until reality forced them to. Because greed doesn't always look like someone stealing money. Sometimes, greed is wanting the dream to be true so badly that you stop questioning it.